Alex Romaines. Welcome to the podcast.
Thanks for having me, Rob.
Well, I am excited to speak to you today on the topic of accounting shenanigans. But before we dive in, I just thought I'd step back for a second. One of the things that I think is really great about our research team is that we're not all clones of one another. Analysts and portfolio managers come from a wide variety of life experiences and backgrounds and different ways of thinking. These are all perspectives that we then bring together to make investment decisions. So I'm going to suggest that you probably don't have the most exotic of backgrounds on our team, but you were trained as an accountant. Can you start by sharing just how that lens shapes your day-to-day job as an investor?
Yeah, absolutely. Definitely not exotic. I think accounting, I don't think anyone would describe accounting as exotic, but it was good training for investing. I think there's definitely aspects of accounting where, it puts people to sleep, but I think a lot of it is really good grounds for understanding financial statements. So when I trained in accounting, I did sort of bookkeeping and then moved into audits, and you get to see the other side, right? So when you're working with a client, they have a way that they want to present their financials, and then it's your job as an auditor to sort of determine whether that actually is going to be okay with respect to the accounting standards. And you get really good knowledge of all different kinds of businesses. I guess the gap is really that your job as an auditor is not to decide whether or not the accounting standards is fairly representing the economic reality. And so when you transition to being an investor and you're kind of on the outside looking in, that's your job. So you have to kind of say, okay, this is what the business is presenting. And the auditors said, yeah, this is good. This is in line with the standards. But you have to ask, okay, well, where might this deviate from what the actual economic truth is?
Okay, because there's a huge amount of judgment that goes into some of these accounting decisions.
Exactly. Yeah, exactly.
So two different lenses, depending on which side you're on. What's been, besides your training, what's been formative in shaping your view as you've gone from the auditing side to the investment side?
When I was training to be an accountant, I did a course on valuing companies, and that was what kind of got me interested in the investing side of it. And I think my first exposure to sort of accounting tricks or the ways companies might present their financial statements a little differently from what you might consider to be accurate would be this book I have right here. So Accounting for Growth, which it's super old, written by an English investor, Terry Smith, who he's well known in the UK. Sometimes people call him the English Warren Buffett. And he wrote this book, and in it, he highlighted a number of public companies and assessed how they were doing their accounting. And he felt that there are a number of ways which a company might misrepresent their accounts. And if they did these accounting tricks, he would put a mark under the accounting shenanigan as he saw it. And he showed that companies with more accounting shenanigans subsequently performed a lot worse in terms of their stock price. And in extreme cases, went bankrupt, turned out to be frauds, which, sometimes we refer to this as forensic accounting, always looking for fraud and crime, but it's all intertwined. And yeah, that was my first exposure to it. And I found that kind of a fascinating tool for an investor.
You mentioned Buffett. He's written on this concept quite a bit too.
Buffett has as well. Yeah, he's a very good accountant as well as being a pretty good investor. And yeah, he's written extensively on the topic. And if you go back and read his letters to investors, he's not afraid to really get into the weeds of what might be the economic truth as compared to the way the company is presenting it from an accounting basis. And we'll get into share-based compensation and stuff like that before, and that's a topic that he's spoken quite a lot about.
I know you're involved in our analyst training program in helping new people who come to the firm as they're being trained in our process and our philosophy. You're often brought in to talk specifically about the forensic accounting process. Can you just share a little bit more about what that is, why we do it, and kind of what that looks like day to day?
Yeah, absolutely. So I think we sort of cover why it's important. I think for new people coming in, it's great to give them that lesson. Like, oh, hey, you're going through your financial statements, and a lot of people coming in have some familiarity with that, but then you sort of go through the ways that maybe they're going to be different. And I think the really important fact is that this is not some distinct, just checklist that you do to tick a box, but this actually really helps you get to the truth of what a company is earning, which is going to be the basis for your valuation. And so obviously you have to prognosticate, oh, it's, the growth could do this and margins could do this. But step one is figuring out what the company is actually earning today. And that's kind of the really important piece there. And so we have this analyst training program, and there are a number of different elements to the course. And one is forensic accounting. And part of the required reading is a second book that I have here.
Oh, he's got more than one prop.
Yeah, I've read at least 2 books. So Financial Shenanigans, Howard Shillett. I think this is kind of the modern Bible for accounting tricks. And there's so many good examples in this book. It's not just, oh, here's what the accounting says, here's what it should be. It's littered with examples of companies that have often blown up. And it details all the warning signs that were in the lead up to that. So it's a really, really good book. And I like to sit in on a meeting where we discuss that and share ideas with people.
And I think to your point earlier, it's not about necessarily like identifying the blow up, right? It's not necessarily black and white like that. It's just, hey, what's the accounting telling us that might be different than the economic reality of a business? Where can we poke a bit further, do more research, speak to management, get a better handle on a specific aspect or change that we notice? That's really the motivation, as I understand it.
Yeah, that's exactly right. And we don't short sell here. So you kind of hope that most of the companies that you screened or flagged as good investments are not going to blow up. So you're hopefully not going to encounter too many frauds because you're not looking for them. But the tools are still really important, even for good companies. And as very good companies, they still want to present themselves, as best as they can, obviously. So it's your job to just kind of see where that might deviate.
The reason we're having this conversation is a couple of weeks ago in a team meeting, you brought up a specific shenanigan, an oldie but a goodie. And I think you had some aspects that were worth just reviewing for everybody, and then pieces that were maybe underappreciated by the market. And that's on the topic of share based compensation. So, for listeners who are unfamiliar, what is share based compensation? Why do companies employ it? And yeah, how material is it out there in the investment universe?
It's very material, and I focus on the US, and it's a really huge form of compensation in the US. Companies will pay their employees in stock or in options. That's less popular now, as a way of attracting talent. And in some cases, it's a really important tool for companies to attract top talent. And a stock compensation piece of an employee's compensation can often really sway them into where they're going. So it's very, very important. It's been around for a long time. I would say the last time you had real debate about the use of equity compensation was around the tech bubble, the last one. So you had stock options were really popular then for Silicon Valley companies, again, to try and attract staff. If you're a startup, you don't have much cash. It's hard to pay people huge sums in cash. So you pay them in stock options. And then, if the company IPOs and the stock price goes through the roof, the employees can make a fortune. And it was great at the time because you didn't have to show an expense on your income statement. And also, if you're issuing those shares, you're potentially transferring a lot of the costs to your shareholders. So it worked for a while, but there was a lot of pushback. And Buffett was someone who spoke extensively about the topic and pointed out the fact that, no, this is a very real expense for the other owners of the business. So eventually the accounting standards changed. Stock options has to be recognized as an expense using option pricing formulae. And the use of stock options, I wouldn't say it went away, but it definitely was greatly reduced. But stock-based compensation did not go away. And it's become more and more popular to pay employees with large amounts of stock. And yeah, there are a few potential pitfalls here and issues where if you just look at the financial statements, you might not get a clear picture of what the real costs are.
Okay, well, I want to dig into those. One of them, just to better understand, you mentioned that the standards changed, where you did have to expense these things, but that might not always show up in the reported earnings, right?
The first piece with specifically stock-based compensation, you have this shenanigan where in the GAAP accounts it will be shown, but the company will try and redirect investors' attention to adjusted figures. So the first shenanigan I see quite frequently is that companies will simply add this back to their earnings and then report adjusted earnings. So adjusted operating income, EBITDA, adjusted net income. And
this is Charlie Munger's when you see adjusted earnings, bullshit earnings.
Yeah, use another word instead of So, yeah, this one is, the accounting body spent a long time trying to clean everything up. And so I guess companies gave up trying to deceive them and just say, okay, well, we'll just add it back and report a different number. And for some reason, this is accepted quite broadly, and you'll see a lot of research that takes these adjusted figures for at face value. But there aren't too many reasons why you should be adding back that expense with respect to stock-based compensation. There are some, but which we can get into. But yeah, by and large, you should be considering this an expense. And if you see a company say, oh, our net income is X, but we're adding back the stock-based comp, our adjusted net income is Y, you should probably be looking at X.
Okay, and if you're an investor who looks at valuation through the lens of price to earnings multiples, for example, and you're just assigning a multiple to these adjusted earnings, you could be really missing out on some of the true cost that's in the business.
Yeah, that's a big one. If you just go on your financial software, often the forward PE is going to use the adjusted earnings as the company presents it. And so if a company just adds stock-based comp back into that figure, then that's the figure you're going to be looking at if you don't go through it yourself. So by way of example, I remember analyzing a company 5 years ago, and I saw that they were adding back their stock-based compensation to their adjusted earnings, and it was pretty significant. And so I did a forensic accounting screen, and that was one of the flags, and we ended up avoiding it, which it subsequently has underperformed the S&P 500, not just because of that issue, but it just highlights that it can be a useful tool. And today, if you open up a number of different investment reports from large US tech companies, you are going to see them adding back stock-based compensation to get to their adjusted net income.
You mentioned earlier that there might be good reasons to do that. It might not, it might not necessarily be a shenanigan. There might be good reasons.
Yeah. So I'd always advise caution when adding things to make net income go up, but there are situations where it might be appropriate. So if you have, for example, an IPO and a company issues, an extraordinary amount of stock units associated with that event, or if you have an acquisition and an extraordinary amount of units are issued in that event, you could say, okay, well, this isn't something that's going to happen every year. So when I'm doing my valuation, I shouldn't assume that this is like a run rate level of stock-based compensation. So that's one example. And then I think other times with specific types of unit that are conditioned on performance, if it becomes unlikely that that performance is going to get hit, I believe even under the accounting standards, you would end up reversing the original expense. So if you see that reversal going through, that's okay.
One of the reasons why stock-based compensation is kind of obviously a cost is, well, as an owner, there's a dilution that goes along with that. Do companies typically try to offset that dilution by buying back shares?
Absolutely, yeah. So this is the second layer of the shenanigan, which I hadn't really thought about, but I was reading a post by Michael Burry, which people will know from The Big Short. But Burry actually used to write a lot of stock blogs, and early in my career, these served as really helpful tools for understanding how to think about analyzing companies. And he raised this exact point that companies are buying back the stock, but the cost of buying back that stock is potentially a lot higher than what we're seeing flowing through the income statement. The reason for this is due to the accounting. So if you take stock units, typically they're going to be either restricted stock units or performance stock units. And performance stock units are different because they're conditioned on performance. And usually that's either going to be something internal, like a revenue target being hit or EBITDA target being hit, but sometimes it's an external thing. So it might be conditioned on the stock price reaching a certain level. Now, restricted stock units are quite straightforward. If you issue an employee 100 units and the stock price today is $1, your expense is $100. Now, those are going to vest, say, over 4 years. You just do $25 a year on the expense. But you can see that this is very problematic if the stock price goes from $1 to $10, and then you have to buy back those 100 units, right? Because it's going to cost you $1,000, but you're only flowing through $25 a year in expense.
So you have an estimate of what it might be worth today on the assumption of just the current stock price being the basis of what that's going to be based off for the next several years. But you're saying in either a rising market environment or more specifically for a company that's fast growing, doing really well, it really understates the true cost of what it'll take to buy back those shares.
Yeah, exactly. And I've had some people say, "Oh, it's only a problem the stock price goes up." And I say, "Well, you're probably looking at it because you want the stock price to go up, and and you're happy if it goes up." But it does create this issue, yeah, where when the company has to buy back its shares to offset the dilution, it's going to cost them a lot more, and that's real money out of your pocket, right? Because that money could go, it could pay a dividend, they could do intelligent acquisition, they could buy a productive asset. So it's definitely a cost to shareholders, and I don't think it's fully appreciated, and I don't think the accounting standards have a great way to deal with it. You could potentially adjust the expense in each vesting period for what the current stock price is and might get you closer to the truth, but it's definitely a problem. And even with performance stock units, now again, I mentioned you get internally based or externally based. As you go along a vesting period, you have to assess whether those targets are likely to be hit and what the likely amount of units are to be issued, because often it's going to be the case that, if revenue is this level, you get this many units. If it's this level, you get this many units. So there's judgment there. But it still uses the grant date share price. So you still kind of have the same problem. And then for the externally conditioned units, it gets even more complicated. And I don't have I don't have the accounting standards fully memorized, but you do a Monte Carlo simulation when the awards are given to value those units based on what the potential scenarios are going to be for what the stock price might be, and then the number of units given. But again, you're basing it on that Monte Carlo valuation done at the time of the award. So you still, if the stock price is rising and rising and rising, you're going to get this problem where it's going to cost them a lot more to repurchase their stock than is showing in the P&L.
You mentioned, different sides of the fence. I wonder if you could jump over once again. So I think if I'm hearing you right, you're saying, okay, there are aspects of stock-based compensation that are well known. Some shenanigans that have been in place for a long period of time. Maybe underappreciated is just this element of what it might cost to buy back shares that doesn't get as much attention as hoped. Do you feel that's something that's underappreciated by just investors, or again, going over the fence? Is management pretty well aware of this? Do they plan for this? Or, I mean, presumably they're the beneficiaries in many cases.
Yeah, well, this is the thing. I mean, a lot of the people working at these companies have gotten extraordinarily wealthy from this dynamic. So, the cynical view is that this is a transfer of wealth from external shareholders to insiders of the company. And I would assume that the management and the insiders of the company are generally aware of this, but it doesn't contradict any accounting standards. So that, they're not doing anything wrong or illegal. It's just they're operating as they're allowed to, and their share price goes up drastically, then the recipients are going to make a lot of money, and generally speaking, the shareholders are going to foot the bill for that.
So what do you do as an investor about this? We mentioned earlier just the simple valuation method of applying a multiple to earnings or adjusted earnings could really get you into trouble. Is there a preferred way of treating some of this? or a valuation method that you think helps to address and correct for some of these shenanigans, permissible or not?
I'd say it's probably not a really well-developed area of business valuation, but I've seen a couple of attempts to do it, which I think at least get you kind of in the right area. I think the most important thing is just to consider it, right? Like if you're just not considering it at all, then I think you could get burned. So just try and consider it and try and come up with an estimate. And the way I've seen it done is you can estimate what it might cost annually to buy back those shares, which obviously is going to require you to forecast the stock price and be a little tricky. But at the very least, you can adjust today's earnings for what they're actually paying to buy back those shares. So that's one way. Another approach would be to perpetually dilute the stockholders. So you assume that, okay, the shares are not going to get repurchased, but that the stock is going to perpetually dilute, and then that is going to impact your valuation as well, which it's another tool which can get you probably a more accurate picture. So there are definitely ways to do it. It is fiddly, but I think as long as investors are just looking at what the cost is and considering it and factoring it into their valuation somehow, they're going to probably get a better result.
Okay. And it sounds like with many things, a probabilistic approach to this is often useful from a mindset perspective.
Yeah, exactly. I mean, what's happened has happened, right? But you're investing based on the future, and yeah, there's a number of different ways that can play out.
Okay. I know we mainly wanted to talk about stock-based compensation, but while I have you, other shenanigans that you think are particularly noteworthy and worth looking out for as investors?
Yeah, so there's some that I've seen recently. I won't go into the same amount of depth, but just I think they're in a conversation. I think they're interesting at the moment. The first one would be depreciation schedules. I know a lot of people have talked about this. Guys on my team have looked at this, and it's another old school shenanigan, right? Companies have a reasonable amount of leeway as to how they depreciate their assets, as long as it's not way off base with what others in the industry are doing. So if you take an asset and you say, well, I was depreciating it over 5 years, but now I'm going to depreciate it over 10 years, well, your depreciation expense goes down and your earnings go up. So again, it can look like you're earning more than you are. And where this debate is really centered at the moment is with the large tech companies, because they have been changing their depreciation schedules, lengthening them, specifically with computing and networking equipment. Some of that equipment is cutting edge GPUs. And I guess the cynical argument is, well, these GPUs are being released at a faster and faster cadence. Presumably, they're becoming obsolete more and more quickly. So why are they being depreciated over a longer period? So that's something I think investors should probably be looking at and considering when they say, okay, company is earning X dollars, but if they change the depreciation schedule, you might think, okay, well, it could be lower.
And just for clarity, are you suggesting that the depreciation schedules that are being used for these GPUs, for example, are just longer than what their useful lives are likely to be? Or are you saying that some of these companies are actively increasing the time of depreciation, like shifting it up, even in the face of this fast-moving technology cycle?
Yeah, well, I mean, you'd have to get like a semiconductor specialist to really weigh in on what the useful life of these are. I don't have that level of expertise, but there is a clue from the fact that they're coming out more and more rapidly. And, the compute is so much more improved each time that maybe they are useful for less long than we think they are. But I can tell you that the large tech companies have been increasing their depreciation schedules 3-4 years, 2, 5, 6 years in many cases. Yeah.
What else is on your radar?
The other one that everyone has kind of seen recently is vendor financing. So you've probably all seen those diagrams where, all these different companies in the AI ecosystem and all the arrows going in all different directions. This is another one from the tech bubble, right? Like you had so many companies that were doing this. And in many situations, it ended badly. So it's like, okay, well, we sell to you, but you don't really have the money to buy from us. So maybe we lend you some money, or we invest in your company and here's a check. And there's different ways you can do it, but essentially you're funding your customers. So if you're looking at a company that's generating significant revenues by doing this, there is a chance that those revenues aren't going to be durable.
Anything else?
And the last one, which I kind of thought was dead, is special purpose vehicles. So like, if you remember Enron, which we all do, that was one of their sort of key features, was the use of all these crazy special purpose vehicles. And something I've seen recently is that companies are creating SPVs to house the debt to build data centers. So those are kind of making a renaissance. And so if you are looking at a company and you think, oh, well, their debt is this, I believe it's going to be case by case as to whether or not it's on balance sheet and whether or not it's recourse. But just the fact that companies are doing this, I think, is potentially something that investors are going to want to look into.
Okay. And to your earlier point, the step one is to really make sure that you're considering this.
Exactly.
One question I have before we wrap up is, so many of the examples that we've gone through, it's all in the technology space. Is there a particular reason why that is? Or are these just simply, we're in a market today that's dominated by massive tech companies, and so obviously that's what we'll talk about?
Yes. I think that it's more the latter, because I have seen some of these shenanigans outside of the tech space as well. But I think that just because tech has become such a massive part of the US market, where I'm focused, even in mid-cap space, it's a lot of tech, it's a lot of semiconductors that are kind of the large, fast-growing companies at the moment. The stock-based compensation issue is a bigger issue if your stock price is rising rapidly. And that just so happens to be that's the sector where that has really occurred. So the difference between what's presented in the financials and the economic reality is just wider. So that's kind of why it's a more pertinent issue in that space. But the issue of paying people in stock, adding back stock comp to your adjusted earnings, is not exclusive to the tech sector. Adjusting your depreciation schedules is not exclusive to the tech sector. So no, I don't think there's anything specifically about tech that makes them more inclined to use accounting shenanigans, but it's just that is where all the money is flowing into today, and so consequently we're seeing the larger issues.
Okay, and the bigger impacts as investors. Well, great, Alex. Really appreciate your time. Appreciate the insights. Appreciate the book recommendations.
Yeah.
And so thanks again for joining us.
Thanks for having me on.